my friends. It's Yara from Arcadia here with you today to introduce a very special replay of our option Zoom calls. We've had a lot of requests for new Zoom calls, and we wanted to give everybody a chance to review what we've already done. And if you have already seen them, it might be wonderful to rewatch and relearn. And if you missed them, lucky you. So we also wanted to send our love and support to everybody who's dealing with weather situations, whether you're in the southern US or in Mexico or anything else that you might be dealing with, whether you're in Canada, Australia, Europe, the US, anywhere you might be. Just sending you all of our love and support today. So please enjoy this video. I hope you learned something and have a great day.
What I really would like to accomplish here is look at the different scenarios. I can say, hey, this is why I think it might be possible. Maybe you think it's guaranteed to happen. Maybe you think there's no chance it happens. We're not gonna, we can discuss that certainly, but I would like at least initially to keep the focus more on just whatever you believe, taking some questions and looking through how, you might go about constructing something that fits what you think is gonna happen. Well, hello there, my friends. Chris Marcus here with you from Mexico for our first Mexican option call, which is quite exciting, especially at this particular time with the things going on. I'm sure everybody has heard about Basel III. We'll do a quick review. Rob, maybe in a moment you can try and put into English what all this British banker jargon actually means. I did go through that report the LBMA put out. Oh my God, it hurt just to read. To imagine someone's life would be just sitting reading legal documents that no one could understand is mind numbing. But, to the degree, and again, it's not a matter of what I necessarily think is going to happen that day. Part of the best, or what I really would like to accomplish here is look at the different scenarios. I can say, hey, this is why I think it might be possible. Maybe you think it's guaranteed to happen. Maybe you think there's no chance it happens. We're not gonna, we can discuss that certainly, but I would like at least initially to keep the focus more on just whatever you believe, taking some questions and looking through how, you might go about constructing something that fits what you think is gonna happen. So hopefully that makes sense. I must also give this disclaimer. Actually, I don't know if I have to since I am no longer on American soil, but just for Ross the boss and MRAC and CCP and all the other fine individuals at the CFTC who are keeping you all safe from internet, Reddit, social media Fruit Loops like myself. This is not licensed financial advice. This is options are obviously very different than physical gold or silver. It's even a step up in terms of risk parameters from mining shares. So, do this at your own risk. Make sure you're talking to people that you trust and can help. I will give my honest answer and feedback on any of these matters, but it's a bit of a volatile exercise. And especially if you're using options, there's a ton of different ways that they can be used. For the most part, I've been buying out of the money call options, waiting to time a big move. Now, in my defense, and I believe they must clarify here because there's something to be said for, it's great to get advice from different people on different things. I think there's also when someone has successfully over time implemented and has developed and demonstrated a skill. So in terms of the silver thing, I guess it's a matter of perspective. I had a big position on, at least big relative for me, in 2011 when the thing was soaring. And that's what started Arcadia, where when the thing got clobbered from 50 bucks, in the middle of everything that was happening, it just seemed a little bit odd. And that was what led me to think either the thing is manipulated and it was going past 50 based on what was happening in the world. The debt ceiling was becoming a disaster. Bernanke was launching QE2. This is when people on Wall Street actually even cared about stuff like that. Actually, I don't even think they cared about it then, but I was left feeling either this was rigged lower or I'm missing something. Here we are 10 years later. If I'm missing something, I haven't been able to figure it out. And either Jeff Christian's right or I'm right, I guess, or maybe there's some other possibility. So now if you're buying out of the money call options in anticipation of a big move, well, your risk there is that it goes on longer. And, you know, most of the time I've gotten clobbered on those for the last 10 years. I never expected it would be quite this long. But I mean, like anything, I think even before actual trading, it's kind of like life often goes well when you go into something with a plan. So I also know what I'm prepared to do. And I left Wall Street, did other things, created a completely different career path rather than a salary, or, you know, there were many years where I didn't have income coming in. So that's going to be different for each person. But if I didn't mention this before, this is not legal financial advice. So you got to talk to your legal people. I'm just giving you research, sharing what I do, and answering questions in genuine fashion. But I mean, again, it's going to be different for everyone. But think about, you know, if you're very conservative, then you're going to approach it a certain way. I mean, if you're going and spending like 20 grand a weekend at the blackjack table and you have a higher risk tolerance, there's different things you can do. What I've liked about the situation, why I've continued doing this, is that depending on how big these things move, I don't know if silver, you know, if the COMEX unravels, or like if Basel III actually ends the paper, gold, and silver market, I don't know, does silver go to 50? Does it go to 250? Does it go to some bigger number well in excess of that? You know, I try not to say like, hey, silver's gonna be $10,000 on the you know, on the show, and I don't know, but it's like also, you know, we're talking about Dr. Skidmore has found $145 trillion of missing money. I don't know if there's really any gold in Fort Knox. So suddenly, like when you just look at, just take a step back and think, how should gold be priced? And not that there's necessarily just one answer, but if there was no dollar, the dollar came around to say, all right, so we don't have to send this clunky metal everywhere. Here, this piece of paper is a receipt. So it's like Ben Bernanke doesn't understand gold. I mean, gold was there before the dollar. It's going to be there after the dollar. And if the dollar was just supposed to be gold, dollars per ounce, it's just a fraction. I have heard one, we'll leave that aside. So it's up to you. I don't know, maybe you could look in Jim Rickard's book if you choose to, in the first one in 2011. He had a bunch of scenarios. One was with like a 40% backing. One was with 100% backing. I remember it was in like the tens of thousands. It was like 40,000 or 60,000. Bill Holter calculates, you know, 80 or 90,000. I mean, and some people use the debt. We don't know how many dollars are out there. We don't know how much gold is out there, but you know, those are the different types of things that you can factor in. So if you think a little bit like this, let's say you think their Basel III is going to completely end it. Maybe they're ready. Maybe, or not even if you think that, but let's say you believe, I would say there's somewhere, a good question. What do I think is the probability of something like that happening? Let's say it's just 5 or 10%. Let's say 5%. Let's even, just to make it like more, you know, in the realm of reason for folks, we'll say it's a 1% chance that, you know, they reset the thing. Well, I mean, what do they reset it to? I mean, if they reset it to $50, that's going to give you one potential payout. They reset it to $500. That's going to skew your numbers a lot differently, because part of what I always thought was cool about options was that you start getting exponential on the curve. I maybe I won't go too deep into, but I mean, it's like, it's a derivative and it doesn't go linear. So especially when you get some of these things that are out of the money, or you get a big move. That's why now some people do this, and it's highly illegal, and I would not do this, and I would not advocate doing it. But when people have inside information on a takeover before anybody else knows it, and they buy those, nickel out of the money calls, and the thing soars, somebody gets clobbered. And basically that was a big part of option trading, not being the guy who got clobbered. Some guy committed a felony, because much like the CFTC, that money usually doesn't come back. So anyway, there are a lot of different ways to approach this. Please, whatever you're doing, think about it first. Start small. If you're in position to trade bigger, then you know what you're doing. Go for it. And with that said, Rob, did you have any questions on that before you gave us a little thought or two about putting Basel III, what's going down here, into English?
Yeah, so I'll summarize it. And I think there are two opposite ends of the spectrum. I've seen Alistair McLeod think that Basel III and SFR is going to completely shut the LBMA and potentially the COMEX. He said that on Liberty and Finance. And then I talked to David Morgan on our show last Friday, and he said he had talked to people that were fairly well connected in the London market, and he didn't think it was going to have a huge effect. So I think there's a wide ranging opinion of what could potentially happen with those new Basel requirements. And essentially what it boils down to is this: they're trying to make sure that the banks are more liquid, for example, so they can pass a stress test. And in times of distress, that they have the right amount of assets that they can get through without basically collapsing. In terms of gold, it affects the London OTC market because they have an unallocated gold position, which is on book. And the European Banking Authority said that they would discount it by 85% because there's not transparency into all the positions. Of course, it's unallocated, so we don't know how much paper is sitting on top of the real gold. Lots of studies have been done on this by Ronan Manley as well as others, Bron Suchecki and many others. And they think that there's not a lot of gold backing that system. So there's wide-ranging opinions on what the NSFR is going to do. The LBMA has put off compliance with this until January 1 of next year. Europe will comply with it on June 28th this year, June 28th, June 29th. And in a nutshell, I think at the very least, there's going to be a ton of volatility in the gold price. And I think from 6 months, July through January, I think we're going to see big effects in the potential for gold to reach its previous all-time high, 2070. I think we could breach it pretty quickly. I think you're going to see a lot of derivative trading going down in the COMEX to control that. And if I were a betting man, I would say the gold price goes up pretty high just because of the uncertainty around the situation and what it means. But I have no idea at this point where gold's going to land. I honestly don't, because everybody that has an opinion on this thinks differently. I haven't found anybody that has a consensus on it. And even the banks, if you read the paper, it's very, the way that they laid it out is very, very confusing. It's not straightforward with respect to gold.
Could you say it was written so that someone wouldn't be able to understand it?
Yes, typical banker talk. They wrote it so that the bankers could basically do whatever they wanted to do. And so whichever way it goes, they can cover themselves.
Come on. Yeah. Especially with the transparency of the CCP, keeping it safe for everyone. So thank you, Rob. And especially on top of that, when we know that we're talking about how are the foxes going to guard, is it chickens or the hens, Rob? What do foxes try to eat most?
Guarding the hen house, I believe.
Hen house. Okay, there you go. So again, I mean, I would by all means, and this is how I would look at it, or this is how we were trained to look at it on the option floor, you're looking at the different probabilities. So certainly by all means, there's a very significant probability that June 28th comes and they say, well, XYZ, we're not doing it. We're delaying it. We didn't get to it. We decided not to. If you told me they're doing all this stuff just to get people to think they're going to do it, and then they're going to ram the price down everyone's throat, that's a possibility too. So anyway, as you can see here, nice free market chart here. And Rob, it was interesting. I was listening to Alistair's call again today, and he was mentioning this whole Basel III thing. Like, I didn't really know the history of it. He was saying this was designed after the last subprime crisis. This was the plan to make sure there wasn't like too much interbank reliance. And I was like, shit, it's a little late on that one, but
Yeah.
um,
Well, there was also an opinion by Hugo Salinas Price, the Mexican billionaire, which is apropos since you're down in Mexico, that he, and I think you mentioned on the beginning of the call that Russia and China had put pressure on the Western gold system, threatened to back their currencies with gold, and that's why a lot of these requirements came about. So it appears as at the very least, and what I've said on my program is that there's a war for, I think, control of the gold market is what this is going to end up being. I think they're going to wrest control away from the London market probably, although we don't know where it's going to go. And I think that's where the volatility comes in. So if you're playing options, I guess you can do very well on options trades during high volatility.
well, I mean, I guess it depends on what volatility level you're paying. I mean, there's always, keep in mind another non-American Wall Street concept of the buying low, selling high. So, that's one of those things that Wall Street really loves conning people into. They say, oh, well, this stock is great. Well, you could have the greatest company ever, but maybe it's worth $1 billion. If the price is 10 billion a share, that's not a great price to buy it at. Similar, as we can dig into as well, there's the gold chart. Here is First Majestic, and for anyone who's seeing an option board for the first time, that's what it looks like. Very exciting. And I'll go slow, and Rob, keep an eye on those questions. If anyone, I want to make this so everyone can understand anything. So Rob, if you can keep an eye, if anyone has any questions, if something isn't clear, please raise your hand and we will clear that up so that you can all understand this as much as possible. So any question is a good question. And
so we have one, Chris, now that you mentioned it, and
right.
I don't know the answer, but Wayne asks, he would like to hear your call on debit call spreads. It seems the decay of buying naked calls for the upward move is what gets everyone. The timing, and considering buying out of the money calls, let's say October, and then selling further out of the money calls so that my cost is low, so on and so forth.
Well, we will get into the calendar spread. I mean, I agree with what Wayne is saying in certain parts of it. Yes, if you do what I did, where you're just buying out of the money calls, be prepared to lose money regularly. Yet, here's the thing. I guess I veered away from this a little bit in the beginning. I was fortunate. I don't know. I mean, it's kind of hard to say, well, they rigged the price. Maybe it would have been that low if it hadn't been rigged. But to some degree, I like to think I got my timing right in 2011. And I sold a bunch of my mining stock shares and converted them into options the 2 weeks before January 29th. And basically, I sat the last 10 years hoping that whenever I thought it was going to go again, I would have a position on to capture that. Unfortunately, Rossi tamped that one down. Although I wonder what it'd be fun another time to analyze probabilities of a potential legal claim. That would be an interesting pricing exercise. So again, yes, you have that risk. Now, what I balance that with, I mean, if you have, let's say you have any call options on and silver goes to like some insane number, say it gets into the hundreds. Rob, let's say silver hits $100. Obviously, we're going to have mania in the market, but the day silver hits $100, what's your gut reaction? What's the price of First Majestic silver?
A whole lot. I don't know, $150. We were trying to price this the last time we asked this question, and we had ranges anywhere from like $150 to $250, maybe.
So you said 150 first. Let's go first answer, which, as the metaphysical gurus often say, is what the intuition is telling us before the conditioned mind tries to let Wall Street do their thing. So let's say we're looking at now the expiration date. You see, this is AG is the symbol. That's First Majestic. And this is July 2nd. let me take a step back. On the left here, and this is marketchameleon.com. My good friend Will McBride built this site, and I like using it. You can see the expirations. So think of it like an insurance policy, and you can buy different lengths. And actually, I'm sorry, to finish Wayne's question, it all depends. When you said about the decaying call options, because if First Majestic, and this is what we'll go into in a second, but you could sit there, like I've mapped these out where depending on the pricing at the time, you could put this on for 20 years. And if silver hit $50 anytime in the next 20 years and you were able to maintain that pricing, you would still come out ahead. Because, you know, if you have $150 silver or First Majestic, as you'll see, we'll go through the example here, we'll see you get such a massive return. Now, if these were being priced, if there were other people in the market that were expecting a big move, then your odds, your implied odds come down, very similar to poker. So, you know, again, it all comes down to what your expectations are. Wayne, with the call spreads, partly I have an aversion to them because, you know, my background is as a market maker, and the call spreads were like always the trades we were the most happy to take the other sides of, because there's already a hedged risk. And plus, you know, people would always overpay from the market maker's standpoint, where if we're flipping stuff back and forth all the time, I don't care if I'm wrong 20, 30, 40, I don't even care if I'm wrong 55 out of 100 times. If I'm getting compensated enough, let's say we have, you know, an even coin, so it's 50-50 heads or tails, but let's say Rob's giving me 100-to-1 odds. If I win twice, and I'm probably going to win somewhere around 50 times, I don't need, the goal isn't, I mean, I don't care about how many times I win. I mean, Rob, would you be okay if you placed 100 trades and you lost $1 million on 99 of them, but you made $1 trillion on the 100th?
Absolutely.
So we want to keep in mind that's a key point, maximizing the total gain. It doesn't matter the win rate. In fact, the guy who trained me, I remember at one point early on, he said, pretty sure it was 53%, that if I was winning on more than 53% of my trades, I was not trading optimally. That makes sense. And if anyone has a question, but essentially, now there's different ways you can approach it. That's from a market maker standpoint, where it's essentially, it's like if I'm the casino or the bookmaker or the blackjack table, and you know you don't need a huge edge, but the math is in your favor. So I guess the other thing with the call spreads, actually, I guess I'm describing the verticals as opposed to a calendar spread. And let me clear up what the difference is. And I guess he was asking about the calendar spread, so I'll answer that one in a second as well. But a vertical would be, sometimes people will buy the 21 strike and sell the 22 strike. So you're going to pay less for that, but you're capping your upside. So similar with the calendars, that would be buying 1 month and selling another, which we will get to in this call, because that was actually one of the things I thought was interesting and I've been thinking about in regards to Basel. So Wayne, hopefully that helped a little bit. And if you have any other questions, let me go through a bit more. And then if the question still remains, we can get you on there and cover that up. So let's go back here. You see here are the different months. These are this First Majestic has weeklies. So they have a set of options expiring June 11th, June 18th, June 25th. Basel date ends up being June 28th. Again, of course, the date can change. So, you know, that's why maybe you think they're going to delay it a week. And you'd say, well, yeah, I don't want to buy July. I think for some reason you decide, you know, I think they're going to, instead of June 28th, they're going to go out drinking and forget to show up, and they're going to take them a couple extra days. So then you could look at July 9th. And we will get into the calendars how essentially if you bought the July 9th, you have an option policy, insurance policy, if we looked at it like that, that expires then. Maybe you only wanted to have it on for that. Maybe you're thinking, I think there's, let's stick with the June 28th date. Let's say we think it's whatever they decide they're going to do on that date. So I'd want to be covered on June 28th. So I can buy the July, these ones that expire in July 2. Say I buy the, we'll look at the 30 strike. So if I wanted, rather than paying, see, if I just buy July, I'm paying for a whole month. But what if you just wanted that week? That's where, and actually, I think that, now maybe why I got confused with Wayne, I didn't, Rob, did he say he wanted to buy the later month or sell the later month?
Let me scroll back up here. It says, it seems the decay of buying naked calls for the upward move is what gets everyone considering buying out of the month calls, let's say October, and then selling further out of the month calls so that my cost is low. He can buy a plethora of contracts as long as it moves up, not necessarily even in my strike. I'm making money. Thoughts?
Well, my thought there is that I think it would make sense if he was doing the other half of that trade, because if you're buying the near month and selling the longer month, so we look here, the July 30 strike, this bid is 6 cents, the offer is 17. We'll call it a dime to make the math nice and easy on that one. So if this is July 2nd expiration, the 30 strike, because of the way options are set up, where I don't want to get too technical tonight and probably have a little review to do on this, but a later dated option, so July 2nd is going to have to be less. Sometimes they could be equal, but August 2nd is going to have to trade over July 2nd. Because if August traded underneath, you can't, like, a 2-month insurance policy is going to have to cost more than a 1-month insurance policy, right? Even, Rob, does that make sense? Let's say you wanted insurance from now until next month and it cost $100. Even if, you know, from next month to the following month, month 2, for whatever reason, there was no value because of whatever the parameters of what you're looking at, it could be worth 0, which would mean that that spread would be 0. But the back month, because it contains the front month, has to be inclusive of that. So Rob, I'm guessing there is, maybe not sure, but guessing there may be a question. Let me know if I need to explain that again. Please, if anyone is not clear on that, I do have a Google Doc up here. Does anyone have any question on that or need that explained again?
I think that's a good explanation. There was a follow-up comment by Wayne. He said, same month, October, buy 31, sell 35 as an example.
So that would be a vertical. So if we look in October, then Wayne, actually, Rob, can you get Wayne on here so he can get right into the questions? Even better than me talking about theoretical stuff. Doesn't do anybody much good.
Yeah, Wayne, if you can, if you're still listening, I see you here, if you'll unmute.
Hi, Chris. I've never played the debit spread, but I've seen some people talking about that's how they're mitigating their exposure on their naked out of the money calls by playing spreads. And since it's consistently moving up, it's just not moving up in large increments and it's not moving fast, that they're consistently making money doing that. And I just wanted to see your thoughts.
Well, if they're talking about that buy right or the covered call, I'm going to be careful how I phrase this. I'm not saying, well, actually I could even make the mathematical argument. I mean, usually it's hard for that to be the best trade, even if the parameters of that trade, because a covered call is synthetically a put. I'm not going to go into mapping out the particulars of that, but I mean, I have yet to see, again, I was on the other side as a market maker, and I'm not saying there aren't situations where that strategy isn't Right. Although, even if that view were correct to capture that, what someone's opinion was, usually you're overpaying by doing the covered call. And what these covered calls, what they don't mention is, let's say First Majestic goes to $50, you're capping your upside there. Now, if you're willing to do that, then, you know, we could discuss how maybe at the end we'll go into that, how it's similar to when you're buying stock and selling the call, you are, we'll save put call parity for a future date, but really the way we looked at it, you're buying the strike. Because if I buy a call, and actually this would be a good thing to map out at home. I'll tell you what, map it out at home, and I'll go through this. I'll have some diagrams ready on the next one, but map it out at home and all this stuff. Don't worry if you get the right answer, but it's like, I could sit here and map it out and everyone could follow and nod their head, but just go through the practice of look at what's the payoff of a call option. Well, if it's flat, you know, when you pay a premium, if it goes below that, you lose your premium. But if it goes up, then it starts going like this. We won't get into the diagrams, but map out what is your payoff diagram. You can find these online. Because if you own a call, but if I do an offsetting stock hedge 1-to-1 for each call I sell a share of stock, that has synthetically converted it into a put position. And again, go through it at home. Even if you can't get it, if you at least try, your mind will be more able to understand it when we go through it the next time. And I will be happy to do that because it's actually really interesting and really relevant. Although I'm going to save that for tonight. But the point is that there's a mathematical level. So it's like, if I really wanted these calls, but I see synthetically I can buy the put at a cheaper level and convert it with a stock hedge. So back to what you were saying, the thing is that usually people are overpaying or people are writing covered calls, at least as I've seen it. And I'm not saying there aren't newsletter writers out there that perhaps have good strategies, although generally, this is just from my perspective, the stuff that I see written in these columns, I've even heard things from people that you know that perhaps are even in my book that say things that were how we funded the cafeteria and the bonus pool at Susquehanna. So with the other thing is with the covered call, let's say even that you decided you wanted to, I think the reason people do it is they feel they're collecting income, which on one hand is true. And I could see that argument for, you know, selling options. I mean, sure, especially if you think the price of an option is overvalued, there's a great time to sell options, or there's great times to be short things. Again, now that is definitely, for most people, is not probably suitable to be shorting options. I don't even have that set up in my account right now, because then, you know, if someone's sitting there shorting First Majestic call options, part of my biggest worry is that if I, like, let's say I have these July 30 calls on for 10 cents, and Basel did go through and First Majestic is $150 stock, my real worry is, am I going to get paid out? Are these guys going to be like, sorry, but we're screwing you because of this ridiculous reason, even though you told us before what would happen? What's it? Yes, I guess the last thing I wanted to say to Wayne, and then you can let me know, Wayne, if you had a follow-up question, is that if you own a share of stock, let's say you own your First Majestic, and what's the price of First Majestic here today? $17. So if you own your share and you sell the 20 strike call, the bid right there is 38 cents. So let's say you whack that guy's bid. If, you know, if it finishes anywhere 17, 18, $19, even up to $20.38 would be your break even, yeah, you'd come out ahead. But here's the thing. if you have that, if you sold that call the day that the COMEX does collapse and First Majestic goes to 150, I mean, you made like, you know, a couple, or you made like a little bit, but you lose out on that big move, which is okay. It all depends on what you're trying to target. Again, I'm not saying everybody should target what I'm trying to target, and maybe I'll be right. You know, we'll see how it goes. But to me, what I'm targeting is the bigger move. Not that everybody has to target that, but the difference is that if you are targeting that and you sell that call, you're capping your upside. So imagine if we boil the last 10-minute speech down to, when you do the covered call, you're capping your upside. So if you want those like returns like they got in the Big Short, where you know, that I've mapped out in some of the previous option videos, you have to be okay with losing many times. Now, had I sold, and let me put this in context. I'm not saying this just otherwise. I think the numbers, and this will make it easier to understand. So I still remember when I first started on the option floor and I was clerking for some of the guys. It was like my first day, and I'm watching the guy's P&L because it's always up on a screen and he's always looking. I mean, you know, like market opens, thing says up $200,000, and it's like ticking by the seconds, 200,000, 178, you know, 20,000, 350. And I'm like sitting there, I'm like, oh my God, this money is fluctuating this quickly. Now, again, you don't have to, I would imagine most people won't be taking positions anywhere near that size. Maybe some people will. But to put that in context, I had an account with about $27,000 in it in January of this year. I think I recorded this, actually. I've been looking for it. It'd be fun to dig into it. But I think before the whole GameStop into 27th into the 29th of January, I think before like the Silver Squeeze weekend, I might have ended up with had about, of the 27,000, I think 10,000 was in shares and 17,000 was in options, which were pretty far out of the money because I bought the cheap ones. And I think the high point I remember seeing on, I guess it must have been the first. It had gone from 27,000 to 195,000. And that was, you know, when things were just over 30. And really the sweet spot when you, like, if you have, I think I had stuff like the 23, 24, 25 strike in First Majestic. When you buy those out of the money options, you know, if you bought those and First Majestic opens Monday, $25, you're going to do really well. But when it blows through that strike, so put in other words, let's say you thought First Majestic was going to go to $25 at whatever time period. If that's where you thought it was going to go, you know, maybe I'd want like the 22 line or the 21 line, because the way options work, we'll get perhaps more into the math a little deeper on this another time. But when you blow through the strike, that's when they really start picking up steam. So again, my thing had gone up 8x. And that was just kind of when it got to the strike. Now, I didn't sell it, and the thing ended up basically being worthless. And I was okay with that. You know, or it didn't go worthless. Then I put it on a couple more times over the past few months until it did go worthless. But again, also keep in mind, I've designed a lot of my life around being able to make that bet. And I waited 10 years. And I was thinking about it. I don't know what you would value it at, but I mean, there's some, maybe you say I have a 5% chance of getting a claim, or there's a class action suit or whatever it may be, who knows, but there's some, and that's the kind of science, there's some probability of that. But more importantly, if from a move of silver from 27 to 30, and a lot of my bet was on First Majestic, there was other stuff mixed in, but let's say it hadn't been tamped down. Let's say silver had gone to 35 or 40 bucks that day. Rob, what do you think? I think First Majestic got up to about $25.
Mhm.
I think I saw it somewhere over 25 bucks. This chart, I think intraday it got on the first, it got as high. I don't know how to do the intraday chart there, but let's say silver had gone up. Let's say silver went from 27 to 30, and First Majestic went from basically 14 bucks to 25. So a $3 move in silver was a 10 or 11, let's call it a $10 move in First Majestic. And
Yeah, it's going to be leveraged. So you're going to, for every dollar that silver price moves up, you should get a multiple on the First Majestic price.
yeah, and there you did. You got a $3 rise in silver, and you got a $10, $11 rise in First Majestic. Now, here's the thing, is partly why I'm willing to take that risk and put it on, and I will do it again. In fact, I've, this is why we're having this call, and I'll describe what I'm looking at. I also, and Rob, we did a call shortly before that, how there was a short position on First Majestic too. So, I mean, it's like you have like 8 million kinds of leverage stacked on this thing. You could make the case that, like, if silver went to 35 bucks, that, or let's say silver went from 27 to 30, a $3 move, First Majestic move 10. This is guessing, but maybe when silver goes from 30 to 33, people blow through the First Majestic shorts. Maybe silver goes, First Majestic goes up 20 on the next $3 move. Of course, it could go up less, but what I'm getting at is that since the options I had were, let's get our board back here, we hadn't really gone through the sweet spot, but let's say silver had gone to 35 or 40 bucks. Instead of, like, on the first $3 getting an 8-to-1 return, you pick up leverage on that. So the next $3 could have been much higher than that. It could be lower than that. Again, we're talking with a lot of variables. And I would suggest to people, keep in mind, I think it's great to have your favorite mining stocks. For the most part, I just look for people who know what they're doing, have good assets, because this stuff is going to be priced by generalists. People are just like flooding. You're going to have billions of dollars once it finally moves, trying to flood in. I don't think people are going to be like, well, First Majestic, their last, drill results and, their production numbers was, 10 basis points better than this one. And I mean, you're just going to have people like, I think there'll be a premium because people know what First Majestic is. I mean, there's, Rob, you've seen this. There's tons of small companies that are great companies, but, as the guy that just is watching CNBC say, like, holy shit, silver just hit 35 bucks. Now it's hitting 45 bucks. Or I mean, if they do a Basel reset and we wake up next month and silver's, let's even forget the big numbers. So it goes to like $50. And we got a little background noise there. So I mean, there's a lot of different things that can happen, but what I'm trying to point out, and perhaps very long answer to Wayne's question, I don't know. I mean, I don't put everything I have into this, and I put an amount based on what is appropriate. I have a different income stream I create. Again, that's where you need to take your own situation, talk with people you trust or licensed people, because I don't know everybody's situation yet. Let's say, I do the same thing again and I happen to have it on, or actually better yet, I don't have to do theoreticals. Let's say Rosti can't tamp down Vladimir Putin. Let's say Hugo Salinas' price is right. And the CFTC doesn't tamp this one down, and we get Rob's number. Let's say we have they reset silver to 100 bucks. Whether it's, I guess, side note there, part of why I think it's possible is that, let's say they're out of metal and they're at the point where they simply have to reset it, similar to how the London gold pool unraveled and they kind of had a de facto reset. Whatever the parameters are, is it possible to me that they could be at that point in Basel III, whatever the legal jargon they use is essentially the reset? I think that's at least possible. And we can take questions about how you might look at a weighted average of that. Maybe say there's 5% chance it happens. Let's say there's, we'll make the numbers easy. Rob, does it sound reasonable? Let's say there's a 10% chance Basel III goes through and silver gets reset to $100 and a 90% chance nothing happens and silver gets stamped down again. Is that at least in the ballpark?
Yeah, and I think you still win in that case.
So sure. So let's say we take $100 and we make this bet. So 90% of the time you're going to lose, right? You're going to lose, and you lose all your premium, at least in this scenario. So you have, oh, geez, it's been a long time since I did one of those. So 90% of the time you're going to end up with 0. Okay. But 10% of the time we're going to end up with something. So in this example, we'll say they reset it to 100. Based on my own studies, research, pondering, and interesting conversations that pop out of the sky from time to time. My guess is when they finally do reset this, it ain't gonna be anywhere near $100, but we'll keep people on the reservation here. Let's say that, you know, they reset it to $100. There's a 10% chance of that, 90% chance you lose all your money. Rob, can you see? Is everybody clear on that? I'll repeat that again. In fact, I'll do you one better. I will put it here so we can. So 10% chance of reset. That includes $50 silver. Well, silver on June 28 and 90% chance the bullion banks hammer it good. It good. Knit good. And calls expire worthless. Rob, can you let me know if that makes sense to you, and simultaneously see if we have any questions, just if this makes sense for the parameters of our example here. Everybody good on that? And if there's any part, there's no question that we can not answer, so please let me know if I need to explain it again.
Looking good.
All right, Rob, did that make sense to you then, I'm assuming, since you did not raise your hand?
Yep, it made sense.
All right. So, and Rob, or no, we said, I'm sorry. Look at my, so we did agree on $100 silver at the reset, right?
We did.
And then we further said, or you suggested that if we had $100 silver, $150 First Majestic. Yeah.
Yes.
So,
that was my call.
Again, more important, don't, like, if you're sitting there saying, oh, this guy's nuts, we're never going to see $150, then just look at how the math is done, and later you can put in whatever number you think it is, and we can leave that as maybe in questions, or we can discuss that more. But again, what's more important here is just so you see how you can start approaching these. And actually, you know, maybe something that could be a good starting point, you know, if you have assets, or, you know, if you have like $200,000 of silver and you take $2,000, put in an option account and trade 1 lots. So you whatever is an appropriate amount for you, even if it's $100, the process of just actually interacting, trading, opening a brokerage account. It's like a lot of people, like, you know, sit there and read about playing the guitar for years and they're like, oh, this diatonic scale is great. And like, wonder which would go better with this heavy metal sound, that or a flamenco riff, but they don't even own a guitar. You got to like interact with it. There's the learning is great and it's a great part, but find a way, or even better yet, paper trade, but keep track of it. You'll learn so much more if you combine that with, you know, again, you can listen to the option stuff I've done. There's other good stuff out there. But really, that's another key, getting some way that get to feel it, because it's just different. It's different when you even if you paper traded but wrote accurate notes and actually reviewed, like, okay, the stock went here, maybe I'd sell my call here, and this is how much I would have made. If you can do it even, you know, small amounts, like a 1 lot, you know, and that way, because I do believe subconsciously when there's money, even if it's not a lot, when you have money, then all of a sudden you're like, oh, well, I don't want to lose my money. It forces your mind to make the decisions and incorporate the information. And especially if you just took $100, some amount that you give yourself the freedom, you know what? Hey, I was going to go to the blackjack table, but I'm going to try this option thing. And if you give yourself the freedom to not need to succeed on the first time, just say, all right, I'm going to use $100 as education, just play around with it, see what happens. That would be infinitely better than just about anything else I could certainly think of, because I just feel there's so much value to when you actually, on some level get started doing it, you start learning more. And if you give yourself the freedom to not need to be right away, also helps a lot. So disclaimer aside, Rob, does it sound good to go? And we'll dig back into our probabilities now that we have the fatherly advice on the matter.
I'm good.
All right. So let's go back to our option board, which is here. So 90% of the time we got 0, but here's the key question. Let's say they do hit it and we're going to buy this. We'll say we could probably wouldn't get filled at a dime here, but on this 30 strike expiring July 2nd and 18 trading days, 6 cents is the bid, 17 cents is the offer, which means if the market were open right now and these were running in real time, you could electronically pay 17 cents. It's being currently offered there. You have a trade and you're good to go. Similarly, you could hit the bid. You could sell at 6 cents. Well, one thing I'd like to point out is, let's say I wanted to buy these. I wouldn't start out by paying 17 cents because actually, and I was on the other side of this, especially, it actually got quite nifty towards the end. Like if we would have all sorts of parameters. So let's say I think my model says this option is worth a dime, and I have what it was called an electronic eye, which was willing to step up for 3 cents of edge, is what edge of a trade, which means if my model thinks it's a dime and someone puts a 13-cent bid in, that would be 3 cents of edge. They're paying 3 cents more than my theoretical value. I could set my thing, so I wouldn't even see it. My screen would say, all right, I'm at 17 cents. Somebody puts 13 cents or better, it automatically would sell that. So here, there's a good chance if you put in a 16-cent bid, you'll get filled. And there's no risk to trying it. Hey, put in a 16-cent bid. If it just sits there and nothing happens, you can always change it and pay 17, but you don't have to pay the screens. Now here where it's 24 at 27, that's some of these markets get pretty tight. Here this one's 38 is the bid, 40 is the offer. So, and here his model, someone could set it, for 1 cent of edge. And if you offered at 39 cents, there I would step up and take it. But the key takeaway there, especially when you see them wider here, try putting in a 15-cent bid or a 14-cent bid or a 16-cent bid or whatever the market is. Keep in mind, you don't have to pay the screen, and sometimes you'll get filled better. And while it might sound like, 10 cents or 15 cents, it's a nickel, what's the difference? Well, that's 50%. So, I mean, you'll see, and we'll go through the math if you paid a dime versus a nickel and this thing went to $150, even if you put $1,000 in there, you're talking about a massive difference in money. So, sometimes you have to pay what you have to pay, but especially trading, it's an ongoing thing. Even when you have a situation where there's like a big move, if it's something you're going to be ongoing, you just let that math sort itself out. And anytime, if you can regularly save 10% on a trade multiple times, that compounds and adds up. So you do what you have to do, but whenever there are times where you can get the same exact thing for a lower price, certainly you want to take advantage of that. Now here, just to make math simple, let's say that I could put a 10-cent bid in here and get filled. So I'd be paying 10 cents for the July 2nd 30 strike is how that would be phrased. Everybody good on that so far? Rob, let me know if we have questions, but otherwise I'll keep going. So I've paid 10 cents for the option to pay $30 for First Majestic at any point before July 2nd in a couple of weeks. So let's say nothing happens, and let's say it just sat there between 17 and 18 bucks until July 2nd. Now I would like a volunteer on this one. So someone who has not yet spoken wants to step up to the plate and take this one. If silver or First Majestic stays between 17 and 18 bucks until July 2nd, would you want to exercise your option, and which gives you the right to pay $30 for First Majestic? And actually, I will say bonus points if somebody actually doesn't know the answer, but is going to be courageous enough to just jump into the pool and say, try, and I'll guide you through it. So Rob, can you pick someone who is ready to become option legend just by getting in the game here?
I think Scott had a question earlier. Scott, do you want to jump on with us?
I was going to make the educated guess that you want to sell before the option expiry instead of exercising the option.
Say that again, please, Scott.
I would guess that you want to sell your options before hitting the expiry instead of exercising them. Like exercising options carries like additional margin requirements and whatnot, right? Like I mean that's a factor I assume might not be directly related.
Not in equity options, or I mean, I guess you could be trading them on margin. I've never traded anything on margin, to be clear about that, and I would be very hesitant to do so, and I would certainly never recommend someone to do that, especially in the silver market. Now, yes, you are correct. You could sell it, but well, let's say that so here's the thing. How do you know when to sell it? I mean, what if you sell it, you're like, I mean, by the time July 2nd comes, the thing's expired. So you can sell it, but then you don't have your insurance policy on. But let's say we took leave that aside for a second if we can sell it. But just specifically, Scott, if First Majestic stayed at $17 for the next 18 trading days, and you owned the 30 strike call, would you exercise the option to pay $30 for a share of First Majestic when it is trading at $17?
No, I misunderstood your question. The answer would then be no.
Right. You would, because you have that option, but it would be considered out of the money. If the thing stays at 17 bucks, well, if you really want to buy the shares, you'll just go out and pay 17 on the open market. You wouldn't want to pay $30 because why pay $30 if things on sale for 17? Does that make sense? Okay, so let's give a big round of applause to Scott. Thank you for jumping in there, and anybody else who's clapping along at home. And that's not sarcastic applause. I do mean that. Thank you for answering that. It will click in your brain in a deeper subconscious level now, which is great. Now, Scott, if you want to play in the game, or Rob, you could pick on someone else. Not pick on, you could choose someone else. So let's say that, just to make this fun, we'll do this in steps. Rob, you can give someone else a shot. So thank you again, Scott. Appreciate that. And you were quite correct. And but let's say before getting to the $150 outcome, let's say, Basel III, maybe Jeff Christian makes a new video or whatever. And First Majestic, let's say Ross can't tamp it down at 30 bucks and First Majestic, for whatever reason, ends up at $50. by this July 2nd expiration. We'll forget about early exercise or selling it early, which yes are options, but we will leave those aside for now. So who would like to come on next and walk through our calculations, which are actually a lot easier than you would imagine. I'll be here to help. But Rob, do we have someone on? Do we have a caller on the line?
I think Alex was asking a question. Alex, do you want to jump in here? Feel free.
Me?
Hey, Alex.
Alex.
Hey,
How are you?
I'm doing great, man. I know I didn't have any questions. I commented in the comments that I got exercised when I went on a little vacation in March on some SLV calls. It was really annoying because of the fees
You were
and stuff.
shorting SLV calls, Alex?
No. I was long the calls.
Oh, and then they gave you and they gave you
I
kind
got
of
it signed. I went on vacation. I forgot to sell them. I fell asleep in the back seat of a Suburban.
well, you probably would have gotten a couple extra basis points on the whole deal. Usually what happens is that they will, like, if they're deep in the money, they'll get exercised and you'll be long the stock. You know, it'll say like, hey, can you deposit another $10,000, but you can just sell the shares. So now if you're able to sell the call and capture an extra nickel or a dime before the close at some point can be good. So yes, and the best part, you got the experience of seeing, oh, okay, if I go away and I have the position and it's in the money, now you have an extra data point. So again, just by playing around and trying it, you're going to learn, which is a good thing. But
I was really
what's that?
I was really happy and laughed about it because it was like $100 or less in like fees because it was in the money, and so it was a very cheap learning experience. Don't forget about those.
Yeah, well, better to learn it than when you're successful solar industry executive leader and putting $100 million on it because everybody else on the planet doesn't know what to do and you do because you got in the game early. So Alex, may I ask you, let's say that you paid a dime for your 30 strike calls and it's finally our lucky day and we're looking at $50 First Majestic Silver. So the price of the First Majestic Silver is now $50. And you have, if you even forget what you paid for it, we'll come back to that. But you have an option that gives you the opportunity to pay $30 for a stock that is trading on the open market at $50. What are you going to do? Would you exercise that option, or would you?
I would look at what people are bidding. I would look and see what the options worth if I sold.
Would you pay $30 for the stock that's trading at 50? If you're $20 in the money, as they say.
Yes. I'll answer that one. I would say yes.
Rob says yes. Alex, what do you think? Or what's the question if you're not even sure what to think? Walk me through what you're thinking.
My thing is that I probably, at $30, I probably wouldn't have the capital to exercise anyway.
No, because if you exercise this for $30, you can simultaneously sell it at 50. Because in our example, the stock is now trading 50. Let's say we're doing it simultaneously. We're not, forget about capital or anything. Just let's say that's taken care of. What I'm getting at is when the stock is trading $50. So if you can exercise these because you have the right, you have the option to pay $30 for a stock. Would you do that if you can simultaneously you exercise it, you're holding the stock and you sell it at 50, capturing $20?
Well, sure.
Yeah, of course. Yeah.
Well, obviously, yeah, it's $20 a piece.
Yeah, I wasn't trying to make it like a trick curveball question. It would be deep in the money. So of course you'd be happy. Now here's the fun part, Alex. So now we said we paid a dime for these, 10 cents, right? So you paid 10 cents for something that's worth 20 bucks, right?
Yes.
So what's your multiple return? It's
I
20
don't
divided
know.
by a dime.
2,000? No,
I don't think
two.
so. Close.
If it's a dime, you got 10, and then 10, it's 100. You got 100-fold, right?
Well, if it's 20 cents or $20 and you're moving the desk, if you paid a dime, so 20 over divided by 0.1, you're moving the decimal place 1 point. You're very close to it. It's coming. It's ready to come out, I believe.
Well, it's $2,000, right? Minus your cost, which would be $10. 10 cents times 100, right?
Well, let's take a step back. Just if you have something worth $20 and you paid 10 cents for it, what is your multiple return? You had it before, you were just off by a decimal. You're very close.
20,000?
20 divided by 0.1.
20,000.
Now.
200.
Yes.
There we go.
There you go. Here,
y'all gotta type that in.
What's that?
You got it.
Okay.
You got the
So
answer.
you have 200x on your
Right.
10th.
So in that scenario, you're getting a 200 to 1 return. So to what Wayne said earlier, yeah, if you put this on, you could basically put this trade on for 200 months. And if you hit it once, you break even. If you get lucky and you hit it after 100 months, then you come out, you've doubled your money. If you get really lucky and you time it specifically, and that's kind of I guess, bringing it back to the whole Basel III thing. I don't know what the probability is that they do it, but I'm willing to pay a dime. So let's say I put $1,000 on that. And let's say I hit it and I get 200 to 1. If I put $1,000 and I get 200 to 1 multiple, how much does my $1,000 become?
You're 200,000.
Right.
Yeah.
So if I made 200 individual $1,000 bets, so 200 months would be, let's see, 12 times 8 is 96. So be about, let's say, 16 and 2/3 years. Robin, is my math correct there? 200
I think
months
so.
is how many years? 16 and 2/3, is that right?
200 months is how many years? 200 divided by 12. Yeah, 1666.
Okay. So basically, at that pricing, and if First Majestic in that scenario goes to $50, I could put that trade on for 16 and 2/3 years. And if I hit it anywhere before then, it'd be breaking even. So if you hit it in year 2, it's going to look really good. And again, you can adjust any of the parameters you want. Maybe you think it goes now. All right. Alex, thank you. Brilliantly done. And now you have even more experience. So everybody, let's give a round for Alex. Thank you. Just winning by participating. Rob, I'm going to give you a fun one. We'll do 2 more of these and then just take some questions. I think we're getting to the point here. Rob, Auditor Rob, let's say before we get to $150 silver, let's say, you said it, not me. You said 150, but we'll just take $100. So Rob, Basel III, we get 10% chance comes and, big move, silver price gets reset to $100. First Majestic's at $100. And you've paid a dime for these 30 strike calls. Now I helped Alex a little bit. Now that you've seen that, can you walk me through the math of what the same calculations I did? Let me know if you need help, but are you comfortable seeing if you can take it on your own, at least to get started?
So $100 and you paid 10 cents for, what was it, the 30?
30 strike, you paid 10 cents and the underlying price. And again, we're not going to talk about early exercise. We'll just assume we're holding it to expiration and the stock is $100. You own the 30 strike and you paid 10 cents.
So you're clearing 70 on the trade, right?
Yeah.
Divided by, is it 70 divided by the 10 cents?
Yep.
Which would equal 700.
And if you put $1,000 on that, that means you would end up with what?
700,000.
So now that means you could do that for 700 months. And let's see. All right, 700 months is how many years? So who will be the first one to get that right in the chat? Well, I'm going to attempt to calculate in my head, see if my mock math is still good. So 700 months is how many years?
58.33.
58 and a third?
Yes, you got it.
Yeah, still got it. We had to go through in mock trading, it's quite an exercise. We had to go through all sorts of, we were doing like calendar spreads and all. Partly, I just figured stop writing it down, just learned to memorize it, and the things we spend our time doing. So what do we come up with? 58 and a third years?
Right.
I mean, would you say there's a chance, like by 58 years from now, you think silver is going to be more or less than $100? So keep in mind, there's all sorts of things like, are we buying one policy? Are we buying many, rolling it over? We won't get into all that tonight. As you can see, perhaps maybe another worthwhile thing to mention, not just option trading, but anything, like don't, I'll say I've gotten better at learning things when I let go of the thinking like I have to know it tonight. I mean, it's like poker. You can always more you can learn. Playing an instrument, there's just, let the basics sink in, and there's not any like finish line here, but just seeing some of these probabilities and how the things map out. And so actually, can we get Wayne back on for a second? Wayne, are you there?
Yes, I'm here.
So Wayne, has that, not to say that my way about going it is right or that my parameters are right, but has that at least addressed a bit more your question of why, at least if one was saying, if I'm thinking about buying out of the money calls, is that putting in perspective the risk profile that you're looking at and why at least I would consider it?
Oh, certainly. Yeah. If someone's going down the path of what I suggested earlier, you're severely capping what your payoff would be.
Yeah, if you sell that call on that, depending on, I'm a little lazy to map out the math on that tonight, but like you get how you're losing that huge. It's like almost like you can buy lotto tickets in something where the odds are stacked in your favor. Either everything I've been saying and everybody have on the show is wrong, or whenever that day happens. Plus, I mean, what if it gets reset to something a lot higher? So again, I'm not trying to say what is the way it's going to happen or that my guess is better than anybody else's guess, but Wayne, does at least now you're seeing the framework, how you can take and insert any parameters and at least understand what you're comparing and how you're calculating, and can take this on any option board and see it for yourself. Does that make sense now?
Yes.
Well, great. So don't go too far. We'll take, actually, Wayne, would you like to do the $150 scenario here? does Wayne not want to do the $150?
So you're saying, what are you saying? I bought in at $10 a contract and we've gone to 150 and the strike was 30?
Let's say 10 cents per contract just to keep the numbers consistent. Although technically you are correct because each contract represents 100 shares. So if you pay a dime for one contract, you're actually going to pay $10. But just, I like looking at it this way because then it makes the math a bit simple. Does that sound okay?
Sure.
So let's say we paid a dime for these calls. In this scenario, you have $150 First Majestic Silver. Can you walk us through same calculations Alex and Rob did? Let me know if you need help, but just try and go as far as you can and see if you can get what our math would look like on that. First Majestic is $150 now. You own the 30 strike call and you paid 10 cents for it. You still there, Wayne?
I'm here. So
If you're just thinking, that's cool. Take your time, no rush. Think out loud if you can. That could be helpful to you as well as others. But whatever you feel comfortable with, I appreciate you participating.
well, I'm doing the multiples in my head. I'm doing the multiples by 100. So I'm thinking I paid $10 for it and it's worth 12,000 a contract right now.
Okay, you can, and actually fine. Let's do it that way, and we'll check both ways. Make sure we get the same math. That's actually a great idea, and I appreciate you bring that up because, you know, especially when you have a lot of numbers flying around quickly, knowing how to do two different ways and check and make sure you get the same answer, you know, can be a handy thing. So walk us through your calculation.
All right. And how many of these did I purchase to begin with? Just one contract?
Let's just say one to keep it simple.
Okay. So I'm up. If I execute at 30, then I'm paying 3,000 to execute. And I was 10 into it to begin with. So I'm 3,010 into it. And I'm turning around and selling it for 15,000 for a $11,990 profit. Correct?
What is your profit number again?
11,990.
11,990. Okay. I think you're making, well, I mean, I think what you're doing is correct. It seems like a harder way to do it, but let's but continue. So you have 11,990 and you paid, so what would be your multiple return? See why it gets a little more confusing that way?
Yeah.
As opposed to, I'll tell you what, and here's the best thing. Try it the way we were doing it. And then you can also like go like load up a spreadsheet, you know, where the numbers do it for you. And I would, in fact, I would highly recommend if anyone get an Excel spreadsheet or a Google spreadsheet. Yeah, I have a spreadsheet I can send people and maybe we'll find the link for that, or Yara, you can actually, no, I don't want to post that there. Build, if you go through the process of just typing these things in, that's how you can really learn. But so I mean, we can leave that aside for now. Just the way we're doing it, if First Majestic's $150 and you can pay $30, what's the intrinsic value there? Is what how we would refer to it. What is parity? What is the intrinsic value? 150 minus 30.
That's 120.
Right. And 120 divided by 0.1. Just moving the decimal. When you divide by
12,000.
just move it one spot over, so you get what?
It's 12,000, isn't it? Did you say 0.01?
0.1.
Oh, 0.1, 1,200.
Right. So if you had bought $1,000 worth of those for a dime, and you have a 1,200 to 1 return, how much does that leave you with?
$1.2 million.
Right. When you started with $1,000 and you turned it into $1.2 million, again, that's up to each individual person to decide. But I mean, geez, it's like, all right, with the last one we came up with, it took 58 and a third years to, you could have that on every month. I don't even feel like my brain's already like, I don't want to calculate, what it comes up to, but you get what I'm saying. Like the numbers get silly. And if you can back these things out, which it can get slightly more involved, but just keeping it simple. Now, again, does that help answer your question of why, whether it's right or not, is for anyone else to decide on their own, but just at least why does it make sense now why I would approach it like I have in some of those situations?
Oh yeah, I completely understand. I guess my question is, are you basing this on the triggering event being the enactment? Because it seems to me the hard part is the timing of the triggering event. I have no doubt it's going to happen.
Right.
I just don't, I don't want to get into year 58 in the scenario before it comes true, because then I'm out a whole lot on naked calls that didn't finish in the money. That's sort of my take on it, is how do you weigh those two to come up with the best strategy?